Hello and welcome. You're watching Closing Trades here on ET Now. I'm Harsh Saita. Very quickly, let's pull up what the Nifty is up to. We're absolutely flat on the Nifty. We've clocked a high and we're in a very tight band actually, just about 80-point band in which we're trading in at the moment where the Nifty is concerned. In terms of just the strength, it's largely IT which is lending support and strength to the index. And when we pull out the Nifty IT index, you'll see exactly that, 3.4%, very, very strong move on the Nifty IT index. And that move sustaining 10% higher on Coforge. That is the real big mover, and that's because of obviously earnings and margins coming in ahead of estimates where Coforge is concerned. When you're looking at some of the others, you're seeing some, again, very decent moves. TCS, some of the heavyweights actually doing the heavy lifting. You've got TCS up 4.5%. It's a very strong move again. 0.5% low on the Nifty Bank though. No big moves there. You're seeing the breadth obviously within the Nifty pack, largely even Steven, but more in the favor of advances. Nearly 30 advances to 20 declines on the Nifty is what we're seeing. Broader markets, there seems to be some bit of pressure. The small cap index down 0.5%, the mid cap index largely in line with the Nifty 50 index. That's broadly the way in which this is shaping up in terms of the day. Let's also pull up the sectoral heat map and try and see which sectors are standing out outside of IT as well. And what we're seeing is decent traction on realty and auto. Both of them are up percent and maybe 1.5% on realty. So that's the tilt. Defense is the big loser, 2% lower post the BEL numbers. FMCG is the other one, 1.4% lower on the FMCG index. The PSU banking index is down around 0.8% thereabouts as well. So you're seeing pressure on some of those sectors and counters. The Nifty Consumer Durable Index is also doing fairly well for itself. It's up around 0.75% thereabouts. So that's really the tilt. Let me quickly also take you through some stocks and especially result reactions. Godfrey Phillips is down 8%. Gravita India is down 8%. Sensex Pharmaceuticals is down 5.5%. Capri Global is down 5% odd. Northern Arc Capital is down 5%. JK Paper is down 5%. And BEL is down 4% odd. Coforge is the one that's really standing out. But Lodha, second straight day of gains, 7% higher on Lodha. Gallant Ispat is up 5% odd. Five Star Finance is up 4%. So that's the tilt of the market. And that's how we are trending at this point of time. It's all about IT, frankly, along with realty and auto. There is some divergence, of course. Certain sectors declining like defense and energy. But Kunal joining us in studio as he always does. A very good afternoon to you, Kunal. How are you looking at the texture of the market today?
See, it's a bit off and differentiated move for the index as compared to the last many days, because in the last many days, we generally used to see participation from the banking names, the private sector banking stocks, and then the bell with the larger cap names. But today, I think it's a differentiated move because the major part of the move has been led by those large cap IT stocks and of course the mid cap IT names which have recovered very, very smartly and seen a very good follow through up move. Realty is the other sector which is showing signs of strength. The auto stocks, I think, also one of the key sectors which have made a good comeback for themselves. So I think it's the underperforming sectors at large over the last few weeks. They're the ones which are making a comeback, and that's why you sense the index or the benchmark index consolidating. However, I think looking at the global construct, I think we're still good in the sense that we are flattish to slight negative on the indices. So I would believe that till the time we hold on to that 24,000 mark over the next couple of days also, the bias would still remain on the positive side.
Okay. Kunal, sector bias at this point of time, this 4% kind of move on IT, do you go out and buy more?
So not buy more, but I think this probably reinstates the fact that what we were telling a few weeks back, that the IT stocks were deeply oversold, and it's a good time to try and add up to the exposure for the large cap IT names and the few mid cap IT stocks like Persistent, etc., which you've been bullish on. What's very interesting, Harsh, with this move for the IT names is that many stocks are now trying to come back closer to their 50s and their 200 moving averages. Now that's a very, very big sign, because when you see large cap IT stocks and those few mid cap IT names making a comeback above their long term averages, that probably gives a sense that the major pain for these IT stocks over the last 6 months, 1.5 odd year, I think now that seems to be behind, and we are looking at a resurrection of sorts. So you'll have to take it step by step. So far, it looks very strong, very positive, with those few IT names which have broken past about their long-term averages. But I would sense that this could probably be a start of a big move for many of these IT names going forward. Buy on dips is what I would advise.
The big mover today intraday is an Avenue Supermart. Achesha here with what's been spoken about on that investor call.
Well, yes, we are seeing weakness on the stock on the back of some commentary that has come in from the management. And first up, let's talk about the store expansion, where the management said that store expansion will be at the rate of 15% for FY27, slower than 20% that we had seen in FY26. Meanwhile, they've also spoken about the same store sales growth, which is likely to be slower than earlier expected. So the management said that the new normal for same store sales growth will now be in mid-single digit. This is for metro cities. So these are the two primary concerns that have come in for the street, and that is exactly why the stock is down 4.5%. Other than that, they've also spoken about the challenges that they are facing in expanding their store count, where they say that capital and manpower are not constraints, but primary bottleneck is the time required in acquiring the land and for construction after land acquisition. Meanwhile, quick commerce competition is also something they've acknowledged in the investor call today. They say quick commerce competition is primarily observed in large and dense metros, especially where convenience-seeking customers might opt for 10 to 30-minute delivery, something that Dmart is not providing at this point in time. While competition from quick commerce continues to remain intense, they say any minor impact on margins is likely offset by operational efficiencies. But for now, competition is a challenge, is one concern. SSSG growth, especially in metros, is likely to slow down, and store expansion is also expected to be slower this year as compared to last. And these are some of the concerns for the street, which is why the stock is declining in trade today.
All right. Okay. Ashesha, thank you for that. That's on Dmart. Kunal, how do you look at the stock on charts?
Yeah, I think Dmart has been a struggling stock, frankly. Harsh, I think the last 3 months, 6 months, the stock has seen a sort of a concern or pain for itself. Whenever there has been any kind of a bounce back for the stock price, it's actually been sold quite viciously. I think, a very recent one was in the month of June when the stock bounced off from 4,000 to 4,400. But then what followed was almost like a 2 or a 3 day retracement from 4,400 levels back towards 4,000 mark and below. Even the last couple of days, we saw the stock just struggling to break or unable to break past about the long-term averages. And today, I think the stock has succumbed back under selling pressure. So this looks like a chart which I think could probably be something which could be avoided from the short-term perspective.
Okay, avoided from a short-term perspective. Kunal, I just want to quickly try and mark out TCS, just that one stock, 4.5% higher on TCS today. How's the chart structure looking? One, I know you're bullish IT, but how's this one looking? And any immediate upsides in terms of levels or downsides at all?
See, what happens, what has happened for TCS is the signals which we looked at it on the daily charts are now getting translated to the weekly time frame for TCS. That's why I was saying earlier that it's a good migration for many of these stocks to start looking at trending behavior, which could last for many weeks to come by, not just over the next couple of days. In that aspect, I think TCS also falls in that similar kind of a category. Now, in such scenarios, what we do is maybe the previous week low becomes the support for weekly traders or the ones who have a positional time frame. So which means that closer to 2200, 2250 mark, which was the previous week low for TCS, that now becomes a support for the stock on the short to medium term time scale. And then traders could look at using any kind of a dip if it comes by for TCS say, over the next 1 or 2 weeks as a good opportunity where they can look to average better their risk reward and look out for targets in the higher range of at least 2600 plus for TCS. But mind you, I think 200 points for TCS, given the context of where the IT positioning has been from major investors, I think would probably assume to be a very good move.
Okay. All right. In terms of buzzers, and there are quite a few at this hour, let's quickly pull up the Nifty 500 index. And within that basket, you're seeing some decent moves, stock action. And I'll quickly pull out a couple of stocks which are buzzing. Godfrey, Gravita, Varun Beverages is down 7%. Kunal, what's happening there?
I think it's got to do with, most of these FMCG names which have gone through a correction. Varun Beverages, what's happened is over the last 2 months, the stock had corrected very sharply from 560 levels. It went down to almost 460. And now from this 460, the stock has corrected towards 430 mark. It doesn't look like that it's a start of a corrective wave, but I think it's just that the pain the stock was going through for the last 6-7 weeks or so, I think the pain has just gotten extended for the stock price. In most of the scenarios where you see such kind of a pain, we generally wait for at least another few weeks before we see any kind of a bounce back or support emerging for the stock price. So as of now, it's a stock to be under the radar, but I think buying could probably happen once we see those bullish signals emerging for Varun Beverages and few of the other FMCG names.
Okay, Ravinder here with some of the stocks that are in news this afternoon. Ravinder, what's on your list?
Well, yes, Orient Pro Solution is under pressure after reporting its weak Q1 FY27 earning. And in this quarter, company's EBITDA declined by 9% on a yearly basis, and company has witnessed an extended timeline in the Middle East, leading to a delays in the project execution. So, back of this, Orient Pro Solution is under pressure. Apart from this, on the back of management risk, Swiggy is also in focus, where Swiggy's quick commerce business Instamart has announced a leadership change. CEO Amitesh Kumar Jha has resigned, and the company has appointed Nandita Sinha as a new chief CEO with effective from August 2026. And Nandita joins Instamart from Myntra, where she served as a CEO and led the platform to become India's largest fashion e-commerce business. On the back of earning, Godfrey Philippe is also under pressure after reporting its weak number, where in Q1 company's net revenue declined by 19% on a yearly basis, and margins has declined from 22.1% to 14.5%, and domestic cigarette sales volume also declined by 2% on a yearly basis. And due to a steep tax increase implemented in Q4 of FY26, the profitability has also declined in this quarter. And lastly, Lodha Developers is also in focus after positive brokerage report, where multiple brokerages have hiked target price for Lodha Developers. And Morgan Stanley has upgraded the stock to overweight from the equal weight rating and hiked target price rupees 1450 as compared to earlier target price rupees 1130. And Kotak Security has also maintained the buy rating and hiked target price rupees 1350 as compared to earlier target price rupees 1330. So back of this, Lodha Developers is also in focus.
Okay, thank you so much for that, Ravinder. Let's quickly slip into a break, come back, talk more. Stay with us. Okay, and earnings coming our way thick and fast. You've got Ambuja Cement's numbers flashing at the bottom of your screen. Weak set at the outset, 30% lower on profitability. And we're seeing obviously some bit of pressure on the stock. Yeah, I mean, all of those gains getting wiped a little bit on Ambuja. That spike getting sold into. Okay. I want to quickly also try and take some earnings and some numbers which have come our way over the last half hour or so. You've got Radico Khaitan, those numbers came in. Indoco Remedies also came out with numbers, and there you go. You can see the spike on Radico stock. Indoco Remedies is the other one where we've seen numbers. You've seen Varun Beverages' numbers. The revenue growth was at 21%. Margin compression playing out. EBITDA was up just 17 and profit was up 15, which is what is the reason why we are seeing a bit of a knock on the stock. We're also seeing earnings coming in on a few other counters. At TTK Prestige, Supreme Industries, we spoke with management as well of Supreme Industries. So that also was one of the stocks which was in focus. But broadly, some of these names are in focus. You're also seeing a Suzlon where numbers came out. Profit was lower, but revenue was 22% higher. EBITDA largely flat, as a result of which margins have compressed from 19% to roughly 16%. And Therefore, you're seeing that pressure on that stock as well. But let me bring on board Srinivas Rao Ravuri, who is CIO at Bajaj Life Insurance, joining us this afternoon, I beg your pardon. Srinivas, great having you. Let me first start off with the market itself, Srinivas. We've seen a bit of a derating, since the highs of the year. But how is it that you're looking at the texture of the market currently in around the 24K mark?
Yeah, hi Harsh. Thanks for having me on your show.
Great having you.
Yes, Harsh. So I think the way we are looking at market is we've been waiting for numbers to come out and numbers to be relatively weak. On the contrary, the first quarter numbers till now, whatever we saw, have been actually better than expectations. I think to that extent, there is a positive surprise from companies, corporate India. And we also saw the war taking a stop and crude coming down, which is a big positive for Indian economy and markets. However, I think again we saw last 10 days things again going back and crude touching 100 has been a big challenge. But I think finally and eventually what we all focus as analysts is on corporate earnings and earnings direction. On that front, I think if you see FY25 and FY26, both years we saw a lower single digits earning growth in Nifty 50, close to 5%. Versus that, now we are heading into year with even today, if I see the consensus numbers, we are talking about almost 15% earnings growth for Nifty 50. So I think, and the first quarter numbers that we saw also reflecting that we will be having a double-digit earnings growth. To that extent, things are looking positive. I would say more than the macro issues, other thing that is actually dampening the market sentiment is the supply that is coming in. We are seeing IPO market, which was fairly lackluster in the first quarter ending June. As markets have revived, we're seeing companies and private equity funds who have made very handsome returns in their investee companies as they went public. They want to sell and book profits. I think that trend is accelerating, and that is definitely putting a pressure on overall markets. So I think if I'm looking at the pipeline that we get from the bankers, we are likely to see even more healthy healthy supply in the coming weeks. So finally, at the end of the day, market is about number of buyers versus sellers. When I see more number of sellers, that is definitely having a near-term impact on stock prices. So I would say it's a fairly balanced at this point of time. Valuations are not expensive. That's a comfort, but at the same time, we would like to see maybe lower supply than what we are seeing right now for prices to move up.
And and Srinivas, the other piece I'd love to understand better is your view on IT. You're saying it's a tactical kind of a trade. We've seen some of that unwind already. How much more if it's tactical, and what's the thesis, if you can give us that?
Yeah, so Harsh, the thesis is easier to say.
Okay.
Markets move in this pendulum, greed and fear. In the last few months, we saw as the globally investors were excited about what's happening in the AI market. We saw Korea delivering fantastic returns, and also investors trying to invest in companies that will be a beneficiary of this AI or who are contributing to this AI. However, in the last few weeks, I'm seeing, I think month to date, I was told South Korea is down 25%. So there is a concern that whether part of this AI is actually a bubble and people are trying to unwind. Coming to Indian IT sector, so IT sector, we've seen a sharp sell-off for the last few months because Indian IT companies are essentially service provider. Within that, most companies are essentially doing code writing. With the prevalence of AI, I think there is a clear threat to that low and simple code writing for sure. And that is why market was worried, and we saw IT companies being where they are today. However, when I see numbers, as a investors, our job is not to buy best companies. Our job is to buy good companies at good prices. From that perspective, when I see especially the large IT names, when they're trading at good 4 to 5% dividend yield on a price to earning trading at 15 times when market is at 20 times, and also for the fact that rupee has depreciated, which in turn means these companies are likely to report double digit earnings growth in the current year. So I think there is a definitely a risk return trade off that is there, and that's what we are seeing in stock prices as well in the last few days. How long this can continue? As I said, it's a tactical call. We have to be mindful of multiple things. I still think there is more steam left, but the fact is AI is here to stay. The fact is it will lead to lesser demand, pressure on pricing for IT companies, which in turn means some of the IT companies will see severe pressure on their top line and margins. We are here to identify likely beneficiaries of this trend. I'm sure a few of Indian IT companies will actually benefit from this eventually as this plays out on the coming 1, 2, 3 years. But overall, sector headwinds are there and will remain. So I think that's where I'm saying tactical. Still, there is some more upside, but I don't want to quantify that number. It is not possible. It's not easy to quantify that number.
I'll come to pharma in just a minute, Srinivas. The other piece that you're really positive about is power companies. Here you believe that the earnings growth will be strong next 2 to 3 years. Now here, do you prefer the larger producers or do you prefer the ones which are shifting towards renewable? Do you prefer the EPC kind of players? How should one play power?
If I'm seeing, my first preference is for utilities, large utilities. But if I want to see where is the earnings growth likely to be, I would say the highest earnings growth would be in the power equipment space. Companies that are making equipment that go into manufacturing of making of power plants and the T&D value chain is likely to see a very high earnings growth. However, I think the T&D equipment space or the power equipment space, if I'm seeing the valuations, I think there is very little margin of safety there. As I was saying earlier, we would like to buy companies where that margin of safety or where the growth is not fully priced in. Whereas when I'm seeing the power equipment companies, I don't have that comfort at this point of time when I'm looking at expensive valuations.
Okay. And with regard to pharma, where are you placing your bets there?
So pharma, you have multiple drivers. One is pure domestic, other one is CDMO, other one is player and generic. We are more positive overall pharma space we like, and within that we are liking more on the contract manufacturing space at this point of time, given the opportunity that space provides. Yes, there are near-term headwinds, but I think directionally, Indian pharma companies have done a lot and are extremely competitive. As a result, we expect them to continue to do better in terms of earnings growth, Harsh.
And what is it that you would be cautious about in a market like this, Srinivas? What is it that you would probably not want to touch at this point of time? Wait for the pendulum to swing the other way?
See, more than sectors, I think in every sector there are some stocks which are fairly expensive and there are some sectors that are attractive. I think in a normal market, we generally tend to say, we like banking, auto, kind of a names, and then we say a few sectors we don't like. But I think what we are witnessing in this last 18 months where markets are more on a consolidation phase, market is rewarding companies that are delivering higher growth and punishing significantly, severely companies not delivering on numbers across companies. As you can see today, consumption, we saw numbers and then we see a sharp sell-off. So to that extent, as investors, and I think what we have in our hand is making sure that we don't overpay for potential prospective growth. So I would say more than sectors, we should be mindful of the fact that let's not overpay And how do I define overpay? I think let's use a simple metric like price to earning. If you are paying more than 50 times 1 year forward earnings, I will put them in a expensive category, and that's where one should be mindful and careful about investing.
Right, Srinivas, thank you so much for joining us, giving us that perspective. We'll let you
Thank
go.
you.
Thank you. Okay, very quickly, we'll step into a very short break, take a bit of a breather, come back, talk more, a little bit of stock-specific action which is at play, and we'll get a sense of how some of those stocks are doing on charts, of course, and get you a funda view as well. Stay with us. Welcome back, and we in fact caught up with Sushil Kumar Modi, the whole-time director and executive director of finance at Macrotech Developers. Stock is up 7%, second straight day of gains on the back of a very good Q1. Here's what he had to say.
What we are underwriting from here onwards is to grow our profit at 20% CAGR for the medium to long term. And this is what you are going to see this year, thereby meaning we are guiding for profit, achieving profit of around 4,100 odd crore. 1/3 of that in a way is already achieved in Q1, but that doesn't mean that every quarter will be like the one which is this quarter. The one quarter should not get annualized. So we stand for delivering 20% growth while in parallel deleveraging and making our development business net debt negative, means cash positive company. We have 25,000 crore worth of inventory in the pipeline to be launched in this financial year. And this quarter in itself, where the pre-sales growth was 4%, thereby need to be seen in the context where we opted for consciously not launching any product, anything significant, and which is where generally when 30% of our sales comes from the newly launched project was missing somewhat. So thereby, on the back of the launches that is planned, we are confident of delivering our guidance that we had given 24,000 crore of pre-sales in this financial year.
Right, so that's on Lodha. Kunal, how are you looking at the real estate pack and Lodha in particular?
Yeah, it's a brilliant move for the stock. After this gap up, the stock has shown 7.5% up move for Macrotech Developers. I think it's a brilliant up move for the stock, and this probably reinstates the fact that the real estate sector has been going through a phenomenal uptrend. Of course, what's happened is over the last few weeks of this rally for the real estate names, the strength or the leaders have changed, and that I think could probably be considered as a healthy sign, because when you generally see a churn within the leaders, it generally gives a sense that the rally is moving on to stages and different phases, where initially you see the stronger leaders which could dominate and solidify or sturdify the move for the real estate pack. And then in the second half, when the market gets a lot of confidence that this is a sector where the trend could sustain, is where you see these high beta stocks within the real estate pack performing quite well. So it's good to see many of these stocks performing very well. Would not call a buy at current levels, but yeah, I think given the fact that traders who've been holding on to long positions over here can continue to hold on.
Okay. All right. So that's with regard to Lodha. The other one is L&T, expected to report a muted first quarter with pressure on profitability despite steady revenue growth. Ravinder here with what the street is expecting.
Well, yes, L&T is set to announce its Q1 FY27 earning, and Street is estimating an overall muted set of number for the L&T in the quarter gone by, with revenue likely to grow 6% on a yearly basis. However, profitability is expected to remain under pressure due to slower project execution, and the core E&C business is expected to remain flat revenue growth as execution continue to be impacted by the geopolitical disruption in the Middle East and domestic labor shortage, and as a result, core E&C EBITDA margin are expected to decline by around 40 basis points to 7.3%. But despite these challenges, Q1 order inflow are estimated between 15,500 to 27,500 crore, and execution in West Asia is expected to remain subdued due to supply chain disruption, logistic delays, higher freight cost and insurance cost, and manpower constraint. However, the project and manufacturing segment is expected to maintain stable margin of around 7.8%. So overall, Street is estimating a muted set of number for the L&T in Q1 FY27.
Okay. L&T on charts, Kunal?
To anticipate, the prospect of the stock post results, but so far it looks like that a major part of the pain for the stock has it seems to be behind. From 4,300 levels, the stock has cooled off to 3,800 mark. The tensions across the Middle East, I think that's also eased off a little bit, at least in the last few days. So maybe I think the expectations for the stock could be to just about plateau and flatten out at this 3,800 levels. But I would look at L&T as more of a high correlated stock with respect to benchmark indices. There's been almost like a 74-75% correlation for L&T in many phases with respect to Nifty 50. So which means if you're bullish on the market, on the indices, then I think 75% chance that the move for L&T would also be tried to replicate. So I would probably be of the belief that 3,800 could be a good point where traders could look to accumulate. But of course, results could probably swing the stock a little bit here or there.
Okay, that's on L&T. HUL is the other one, weak quarter. Management is confident that FY27 will end up better than FY26. Here's the MD CEO explaining her rationale.
If we see your EBITDA margin, the calculated margin is below 22%. It's 21.7. So for this financial year, are you expecting to revise your EBITDA margin lower? If you're expecting to keep the EBITDA margin in the 22.5 to 23.5 range, what gives you the confidence? Is it the monsoon? Is it the consumer demand? That's one part of my question. My second question is, if we see volume, again, a bit subdued growth in the first quarter. So for the overall year, what's your outlook on your volumes, on the underlying volume growth? And my third question is, what's the outlook on raw material pricing, especially for commodities, tea, coffee?
Maybe I'll take the last part of the question first, and then Ranjan can add. So in terms of inflation, it remains a volatile environment. And we are closely monitoring, both the geopolitical situation, the monsoon conditions in the country. And we believe that in September quarter, we will see sequential inflation. This could be depending on how inflation pans out, between 2 to 5% sequentially for September quarter over June quarter. And we will take calibrated price increases as we have been taking in June quarter. The same we will do in September quarter, but really leverage all the lines of our P&L. So it remains volatile. Given our portfolio, which spans across and spreads across both categories and the depth of our portfolio across price architecture, we believe that we are in a good position to ensure that we navigate this.
And coming to your EBITDA margin, I would like to correct you that if you look at the consolidated EBITDA margin, which is what we report, it's actually 23%. And our EBITDA guidance is also on consolidated EBITDA margins, which is 22.5 to 23.5. And our margin reported for this quarter is 23%. So we are well within the guided range.
Well, that's the management of HUL. Stock taking a knock of 6.5%. Kunal, how is it looking?
Yeah, tough to call in a bottom over here for the stock price, because after such kind of a sharp sell-off, this just puts in place that HUL was one of the weaker stocks in the entire FMCG pack over the last many weeks. At one point where there was a move on the higher side for Nestle, Marico, Britannia, etc., HUL was one of those few stocks which are struggling. So it doesn't come as a surprise, because it looks like that the traders or investors maybe went into the results with a sort of lower expectations, and the stock has disappointed further. So which means that we could be looking at a point where over the next few days, maybe sub the 2000 levels is where the stock can show signs of better risk reward. So not a bad current levels, but yeah, sub 2000 mark is where I would believe that maybe a better risk reward could originate purely from a long-term view.
All right, slip into a very short break, come back with more. Stay with us. back, and we're joined by Sunil Subramaniam, who is market expert this afternoon. Sunil, IT, this kind of very, very strong move. What's the view there now?
I think a kind of bottom is formed there. And I think the trigger there is two, three things. One is, I think, Jeffries making a big shift in terms of underweight to neutral on the IT sector, including Infosys in its model portfolio. These have been big triggers, and it's not just India specific. Even in the US markets, we see companies like Accenture have kind of recovered dramatically after their very disappointing earnings call a few weeks ago. So I think there is a bit of value buying stepping in here, and some inherent sense of rupee devaluation, because we know that there are strong short-term rupee positives there with the FCNRB and all those stuff. But if you look at the forward premium, they're still showing close to 3% of rupee depreciation 1 year down the road. So IT represents a bit of a hedge against that for FIIs. So there's some value buying. I would still say that the sector is not yet, kind of viewed from a growth perspective. But I think that selective value is emerging, and people feel that the margin of safety has probably increased, that it can't get worse from here. Because parallelly, there's a AI tech sell-off happening across Asia and the NASDAQ. You're seeing that all the huge amount of capex spend that's gone into AI, now people are questioning that is there a return on investments, or everybody's going after the same holy grail? So are there going to be a few failures and a few successes? So some money being taken off the table of the AI piece means that technology-oriented funds probably need to reallocate into the services sector. So you're seeing a culmination of all of that gradually happening. But I would still hold my horses in terms of looking at IT as a growth pick yet. It's still a value pick. And probably from a trader perspective, you can look at the low valuations, you can look at the high dividend yield and say that there will be some amount of pension fund, long-term income seekers buying, coming in and supporting at this level. So I would say with the kind of downside being a bit protected, there are possibly opportunities for tactical players to make some money on the table. So to summarize, I still see IT as a good part of your value part of your portfolio, not yet a big part of the growth part of your portfolio.
Okay, Ambuja Cements came out with numbers. Ashesha here dissecting those.
Well, yes, so largely in line set of numbers, and we haven't seen any major stock reaction either after the company reported its numbers. And let's start with the top line figure, where revenue has come in at 9,500 odd crores, which is a decline of 8% YOY and slight miss as compared to street expectations. But margins have come in line with expectations at about 16.5%. Volumes, meanwhile, have seen a decline, but much like most other cement companies and in line with expectations, this decline has come in line with what we were working with. Remember, one of the major concerns for most of these cement companies is cost spike on the back of West Asia. We have seen fuel prices go up. Power costs have also risen by about 1.7% YOY. Fuel cost is up 4.5% on a year-on-year basis. But the company says that they achieved cost reduction of about 206 rupees per metric ton on a sequential basis. This is led by the cost optimization efforts that the company has undertaken. Other than that, remember, the capacity expansion plans continues to remain intact. The company says that the capacity currently stands at 109 MTPA, and this is expected to rise to 119 by the end of this fiscal. So clearly, they are expected to add 10 metric tons by the end of this year itself. Meanwhile, they said that they've started FY27 on a strong momentum despite the cost headwinds that the company is facing. So no major negative or positive surprises as such, largely in line with what we were working with. Yes, volumes have declined, but this was also expected.
Volume decline expected. Sunil, how are you looking at the numbers from the cement makers?
I see that the larger players are able to hold off. They've achieved cost synergies. They've been able to manage the crude price increase well with certain rationalization. But the small to medium players are probably going to suffer because they are highly operationally leveraged. Also, they are the one sector which will hope for a relatively bad monsoon because monsoon activity, as it picks up, construction activity slows down. So in the near term, that's the one contra to the monsoon. While you'll have your agriculture and fertilizer and consumption, rural consumption, all praying for a good monsoon, you'll have the cement sector doing the opposite. So how the monsoon plays out also will determine a near-term future for these companies.
That's with regard to cement on charts. Kunal, cement from fundamental standpoint. Kunal, on charts, how is it looking?
Yeah, I think nothing exciting. I think except for maybe Ultratech Cement, which had moved up or showed some signs of recovery few weeks back, or I think a week or back for the stock price when it came back to that 12,000 levels. I think you've hardly seen any major cement stocks showing any kind of a reprieve or any kind of a major up move. Ambuja Cement at current levels of 420 is still almost 15% lower than its 200 moving average. You look at ACC, that stock is also down by more than 15% from its long-term moving averages. So the first level of a breakout which we look out for is 200 DMA. Even that's not been crossed over by these by many of the cement names, and that's why I think the sector is going through its own patch of consolidation.
Okay. Mithali here with a roundup of the Q1 FY27 for the banking heavyweights. How's it looking, Mithali?
Right, so for Q1 FY27, for all these large private banks, if you see the story of resilient earnings that played out in this quarter, while profitability it remained healthy, but talking about their margins as well as the growth, they remained the key trend setters, separating the winners from the others. Talking first about the margins, those remained under pressure for this quarter across the sector, while ICICI Bank was the only exception who could expand their margins on a sequential basis. Talking about the loan growth, it was quite robust and driven by healthy corporate credit growth. But if you see the deposits, the growth, it remained a key area to watch as the loan to deposit ratio, they kept quite elevated. Asset quality, it continued to improve with benign credit costs and also stable stress formation across the board. Return ratios, they remain quite resilient despite the margins pressure that was seen, with ICICI Bank delivering the biggest earnings beat for this quarter. And finally, if you see the funding costs, they seem to be easing gradually, but banks will need further strong deposit mobilization, if you see, for this to support their next leg of growth. So clearly, for Q1 FY27, it was a reinforcement of the strength for these private banks that we have seen. ICICI Bank, it clearly emerged as a standout performer, with HDFC and Kotak delivering a strong and steady execution. While for Axis Bank, it will need that margin recovery to regain earnings momentum, and IndusInd Bank's turnaround profitability as well as improving asset quality, they were quite encouraging. So yeah, good numbers that we saw for Q1 FY27 for all these large private banks.
Thank you so much for that, Mithali. Sunil, let me come to you. Private versus PSU, that's the eternal debate. Where do you sit?
I sit on the private side. Despite the NIM compressions that we are seeing, except for the one bank, which ICICI Bank, the key point here is credit growth is strong, credit quality is good, and I would say that in a period where if credit growth is going to sustain, the NIM should come back, creep back on. Right now, there's a negative reaction because of the NIM compression. So I would say that ultimately, if credit growth will drive it, then the pricing will take care of the NIMs in the future. So they are doing a good job of actually hiking deposit rates to get in matching capital, that is to the weighted average tenor of the loans. So you see there's also an adverse deposits to CASA balances going, because they're clearly shifting. They're not using just CASA to fund medium-term loans. I see that as a healthy progression. In this quarter, the blip in NIMs is actually good because they are taking care of the ALCO, the asset liability composition. And going forward, with the lending creeping up, the price into quantity will play out. The price is of the NIMs, but the quantity, if the credit goes strong enough, absolute EPS should trend up in the next few months. So I would still say, despite the less than expected private banks, earnings and the stock movements, I will still place my near-term call on them. On PSU banks, credit quality continues to be strong, but you can see that sequentially a little bit of compression. So in fact, the market is reflecting that. If you see 1 year, the PSU banks have outperformed the private banks, but you get down to 3 months and 6 months, the private banks are slowly gathering the leadership from the PSU banks. I expect this trend to continue. So from a 6 months to 1 year perspective, my call is on private banks as compared to PSU. But you stretch the tenor to a year and a half to 2 years, I would still bet on PSU banks coming back on track with the SME, MSME lending, supporting the capex kind of a growth, they will come back on track. But right now, I would still favor the private lenders.
Okay, we'll slip into a very short break, come back with more, some real buzzers. I want to quickly mark some of those out. Chola Finance, City Union Bank, 7.5% move. Chola Finance down 5, both on the back of numbers. We'll slip into that break, come back, talk more. Welcome back. Joined by Shivangi Sarda of Motilal Oswal. Of course, Sunil still with us, Kunal still with us. Shivangi, how are you looking at the market today? How do you assess the move?
Yes, very good afternoon. So we've seen that volatile cues can be seen today because of the monthly expiry as well. And we're round about, near the psychological levels of 24,000 levels. But once we are, to cross 24,200, then only a fresh leg of rally is to begin. So we're struggling near these levels, but a broader range would be intact for the index. 23,800 is the support that we're looking out for, and the resistance at 24,200 marks. So buy on dip within this range to continue for the index because support-based buying is intact, but upside remains capped as well at the same time.
What's the sense on Suzlon, Shivangi? What's the take there?
Sorry?
Suzlon, Shivangi, the stock is down. Just trying to get a sense as to what you make of that one on charts. Opportunity to buy, or would you avoid at this point?
So Suzlon is given a breakdown, and definitely it would be an avoid for right now because we've seen that the stock has been in a downtrend from the last 5 weeks, making lower top, lower bottom formation. So definitely weakness is persisting over here, and we would definitely wait and watch on this one.
Okay, wait and watch on Suzlon. Do you have a view on this one, Sunil?
No, I'm not stock specific, but generally on energy.
How would you play power? Would you play through some of these related plays? Would you play through the EPC kind of play?
Obviously, yes, because the direct power play, it took the overall energy pack itself. I think you have to take the Trump factor into account on oil prices and what happens to that. So it's a highly uncertain period. I know right now we are going through relief because instead of talks with Iran are promising, but Trump, right? Tomorrow he could turn around and say, I've decided to attack them. So I think the whole energy-related power, oil and gas, all of these are very, very nervous plays is what I would say. I would rather prefer to wait and watch at this point on this whole pack.
Okay, so that's the take. Let me go across. Darshita's here with Coforge's numbers. Good quarter for Coforge. The Oncora acquisition gaining steam and coming into the financials. How are the numbers, Darshita?
Right, Coforge reported a strong set of Q1 FY27 earnings with revenue comfortably beating the street expectations. While the bottom line came in slightly below the estimates, the overall quarter reflected healthy execution and a confident management outlook. But the biggest takeaway was the quality of growth. The organic growth improved sequentially, coming in at 5.2% in the CC terms, and reported a record executable order book of $2.23 billion for this quarter versus $1.55 billion same quarter last year. And the Oncora acquisition has now been fully integrated operationally. According to management, strong demand, improving deal visibility, and a rapid expanding AI deal opportunity pipeline position FY27 to be an exceptional year. Now, on the earnings call, management made an interesting observation. It expects to sign almost as many deals in the second quarter alone as compared to as the company used to sign in an entire financial year 3 years ago. Another key highlight was the AI-led
engineering, data and cloud business now contribute to 86% of the consolidated revenue. Management also said that the AI is creating some pricing pressure, but strong demand continues to be more than offset that impact. The company has also reiterated its FY27 guidance, maintaining confidence in delivering 20.5 to 21% for the EBITDA margins, while 16.5 to 17% for EBIT margins on a stand-alone basis, and 100% free cash flow to PAT conversion. Now, looking at the brokerages, Morgan Stanley has also maintained an overweight rating with a target price of 1700 rupee, reflecting continued confidence in Coforge's growth outlook.
Okay, thank you so much for that, Darshita. Shivangi, how do you look at Coforge in particular on charts? This 10% move really changing the chart structure.
Definitely, Coforge has been in action today. And of course, we've seen that the entire IT pack has been holding on to the index quite well, despite the Bank Nifty doing quite poorly or underperforming. The Nifty index was being held by the IT index alone. So Coforge has definitely done pretty good with price volume surge, and we're seeing that good amount of short covering can be seen on an expiry to expiry basis. So definitely this one would be on radar, but of course we're looking at a stop loss at 1650 levels. It has kind of surged today, so we'll kind of stagger the target as well. The first immediate targets that we could look at is 1750 levels.
Well, 1750 immediate target on Coforge. Kunal, some of the gainers on the Nifty, I'm going to quickly try and pull those up. Eternal, Tech Mahindra, Eternal doing ever so well, right? What next on this one? You're now beyond 200 where Eternal is concerned, Kunal. I also want to pull up a Swiggy, try and take a chart check on both of those.
Yeah, I think Eternal is now beyond 300. I think it's been a brilliant move for the stock. In the last 3 months or so, March low, the stock was around 213, 214, and now we have seen the stock crossing 300 plus levels. Of course, in the last couple of days, the momentum has accelerated for Eternal, but this just reinstates the fact that the stock has been into a very steady and a strong uptrend. And historically, we've seen that whenever the stock goes into a recovery post results, the moves are in the range of 10 to 15% at least for Eternal. So which means from those lows of 280, 285, last week for the results for Eternal, we could be looking at 310, 320 as a range for the stock in terms of a target. Tech Mahindra, difficult to give a buy at current levels, but I think the move in the IT stock is now getting into the second leg. It's just that on the hourly charts, the RSIs for so many of these IT names are hitting levels of 80, 85. So I'll be a little uncomfortable in terms of initiating a fresh buy, but for traders who have bought at lower levels, they can continue to hold on.
All right. Thank you so much for that, Kunal. We'll let you go on that note. In fact, thanks so much for giving us all of your views. Now, in terms of back to Ambuja, and the stock has come under a wee bit of pressure post the numbers, but there's been a decent recovery post that as well. And despite cost pressures, Ambuja Cements believe that they will continue to drive cost reduction initiatives, which will aid profitability going ahead. Listening to Vinod Baheti, listen to what he had to say.
Our strategy remains focused on creating sustainable value ahead of volumes. Hence, we use the opportunity to maintain 12% of our kiln capacity in terms of scheduled maintenance, absorbing additional cost of rupees 50 per metric ton, while we built up clinker inventory of 1 month and coal inventory of almost 3 months, giving a competitive edge in second quarter. Trade sales increased to 78%, supported by growth in premium products, which stands now at 34% of the trade sales, while blended cement sales remains robust at 85%, thereby helping to improve on cost on account of lower clinker factor, which has now reduced from 67% to 64%, almost 3% reduction in the clinker factor. Our 109 million tons of capacity integrated cement platform is aimed at converting scale into higher productivity, stronger profitability, and superior returns on capital. Regionally, North continued to lead profitability, East and Central recorded significant improvement, West remained resilient, and in selected southern markets, we prioritized profitability over incremental volumes. We are firmly on track to deliver a rupees 250 per metric ton cost reduction to achieve our guidance of rupees 4,250 rupees per metric ton for FY27.
Well, that's Ambuja Cement. The numbers are below estimates, or largely in line, I would say. It's a bit of a mixed bag, really. While the top line has come in below what the street was anticipating, the EBITDA has come in line, but again, it's a downtick of about 18% on a year-on-year basis. And the EBITDA margins are largely flattish, one would say. The profit as well, which is a downtick of 34%, is in line with the estimates. Volumes as well have come in lower, about 7% or so. And it's the cost spike, which is why you're seeing a bit of a dent come in on the earnings, because the fuel cost, remember, because of West Asia, ran up about 4.5%. Power cost as well was higher by roughly about 2%. And the company is saying that they achieved cost reduction of about 206 rupees PMT on a sequential basis, led by focused cost optimization initiatives. But we've still got Shivangi Sarda as well as Sunil Subramaniam on the show. Sunil, hi, just joining in the conversation. Wanted to understand what is it that you're making of the entire QCOM space, because one large unlisted player, and we understand that the valuation already has halved from where it set out in the first round of its fundraise. That said, what does it really imply for the rest of the two players in the market?
I still think that it's overall positive, despite what you just said in terms of these are just market moves. I think the overall expansion of the market itself is a huge positive, and all the players should ultimately benefit from it. So I'm not so worried about it.
Interesting you say that. Shivangi, let's have you stack up both Swiggy as well as Eternal. While Eternal, of course, has, clocked very smart moves from those March lows of 213 thereabouts. But between Swiggy and Eternal, if you had to take one trade, which one would it be?
Out of the two, Aisha, I think I would go with Eternal because this has been a performer over the years, and this has also been a portfolio stock. Eternal has done pretty well in the last 2 to 3 months with gradual and slow buying, but we've seen that every small declines have been utilized well. With the last 2 trading sessions, the trade is, of course, confirmed over here. And we're recommending this one for the next target of around about 320 and with the support of 300 levels on an immediate basis.
320 is the next target that Shivangi is foreseeing on the cards for Eternal. Today, of course, the big story has been IT led by Coforge, which is now scaling higher by 10.5%. There's Lodha, which comes a close second with an 8% of a bump up. Kalyan Jewellers is back in the green, and after a stupendous last fortnight, it's up another 8% as we speak right now. And then, of course, on the flip side, there are those weaklings like a Suzlon, Godfrey Phillips, both earnings reactions. Varun Beverages as well, which has now slipped about 7%. Look at a Unilever, that too has fallen 7%. I quite frankly don't remember the last time you had a large cap sedate name from the FMCG pack like a Unilever fall this much. And Nuvama as well, which is lower by 6.5% as we speak right now. Tata Power too, very actively traded. We chatted with Praveer Sinha as well earlier this morning, and he had very bullish commentary and visibility about the quarters ahead. In fact, we will try and bring up that soundbite as well. Tata Power right now too, lower a little bit, 370 thereabouts is where that stock is. But Shivangi, let's have you read the charts for Tata Power.
Yes, Aisha. Tata Power, especially the entire power energies pack, has been doing very selectively. Tata Power has kind of given a slight bit of a breakdown over here on the immediate time frame, but of course it has been moving very weak from the last 3 weeks. So, space, I feel that there are better stocks that one could focus on, and Tata Power would be a little early to chase right now. In the energy space, Adani Energy Solutions could be kept on radar. This one has been doing quite well. Apart from the last 2 sessions where there has been some profit booking, but this one is a much more resilient one in the entire space.
Yeah, in fact, that QIP as well opened just yesterday, and it's a sizable fundraise that Adani Energy Solutions is looking at. But since we're talking about Tata Power as well, hear it out from Praveer Sinha, the CEO and MD, who highlighted the company's 27th consecutive quarter of strong performance and believes in delivering another robust year in FY27, backed by sustained capacity additions and, of course, business expansion as well.
This quarter has been phenomenal, but I think this is the 27th consecutive quarter in which we have shown growth in revenue and PAT. So I think it's on back of very consistent performance of all our businesses. Some are doing exceedingly well, but all of them are doing well. What we are seeing is that with more capacity adds that is happening, and typically the first quarter is little muted compared to the subsequent quarter. We will see more than 4 to 4.5 times of every of these parameters on revenue, EBITDA and PAT. So you can expect a very good year from Tata Power in FY27. This quarter, it is the highest capex that we have done, and that demonstrates that now all our projects, especially the utility scale renewable projects, are getting implemented very fast. We earlier used to do a lot of third-party projects. Now we are doing everything in-house. So this year we have a plan to set up nearly 2.5 to 2.7 gigawatt of renewable projects.
Okay, the other couple of stocks which have come out with numbers and buzzing in trade is Chola and City Union. Mithali here, breaking down the numbers for us.
Right, so let's start first with Cholamandalam Finance, another robust quarter for the company. Net profit has surged nearly 46%, while if you see the net interest income, that has seen a surge of 27%. Also, the company has approved the regulatory approval for raising nearly 55,000 crore rupees via NCDs. While a key monitorable to watch going ahead will be their asset quality, because for this quarter, sequentially, there has been inching up of their gross NPA as well as the net NPA. Although the provision coverage ratio, it remained quite broadly stable. So overall, a robust quarter coming in for Cholamandalam, but that asset quality is something to watch for going ahead. Moving now to City Union Bank, so another well-rounded performance coming in from this company. Net profit has risen 25%, driven by a 31% increase in the net interest income and also a 29% increase in their operating profits. If you talk about their margins, they have also expanded to 3.78% from the earlier 3.54%, supported by lower funding costs, while management it continued to maintain their margin guidance. Business momentum, it was quite healthy again for this quarter, with advances growing up 25%, while deposits were up 21%. Talking about their asset quality, it continued to improve. GNPA declining to 1.73%, while the net NPA falling to 0.61%, reinforcing the bank's disciplined underwriting. So yes, quite a good set of numbers coming in for City Union Bank, and a steady quarter, you can say, or a robust quarter for Cholamandalam.
Okay, thank you so much for that, Mithali. In fact, Sunil, I'm curious to know, some of the smaller banks, we spoke about private versus PSU, but some of the smaller banks have really done well this quarter, right? I mean, an AU Small Finance, an IDFC First Bank, maybe not small finance banks, but some of the mid-small ones, a Federal Bank.
Yes.
What do you make of some of those? Should that pocket be the ones in which you take the bets?
Yeah, actually, I think so too. Because I'll tell you what's happened is that they have historically been higher cost deposit raisers compared to the larger private sector banks. So on a competitive basis, though the larger banks are trying to hike the deposit rates, and that's why you're seeing the deposit cost going up and the NIMs compressing. For these smaller banks, their costs were anyway high. So they didn't have to really raise them much. So you're seeing the opposite picture there. You're seeing the broad wide that the NIMs are actually improving. And their NPA levels also continue to be stable, stroke declining. So I think that what's happening is that the gap between the deposit rates of the larger, the smaller is narrowing. And the smaller guys are able to, because of the franchise element, raise it. And they were always lending to a higher borrowing rate segment, right? Because of the nature of their business model. So that's how their cost versus the advance rates, the NIMs are able to expand. So I think that the smaller banks are probably the ones which are a better bets, I would say, in terms of the immediate future, while the market, senses that the larger banks' NIMs are under pressure and there is a bit of pressure on their prices there. But the smaller banks are definitely beating them in terms of expectations versus performance.
How is it looking like on charts? Shivangi, how is it looking like on charts? Yeah, please.
Yeah. Looking at the entire banking space on a whole, we've seen that this index has been underperforming from the last few sessions. And I would actually recommend a little wait and watch over here. We've seen the smaller banking trying to hold up strength, but overall the heavyweights are actually giving up. So overall, banking stocks could take a little bit of a backseat as of now. But of course, we're expecting some range-bound moves here. Momentum is slightly missing, but we'll of course look out for the rollovers as well. Talking about Bank of Baroda specifically, we've seen that this one has been kind of in a downtrend from the last 5 weeks. It has been making lower top, lower bottom formation. So as of now, I think one could actually a little wait and watch over here till the time it kind of bounces back, because it's broken an immediate support zone of 240 levels.
Okay, that's that and some of the actively traded banks and how they've been reacting to their earnings. Just looking at the screen right now, and while we're closing in pretty soft for the day, today the standard performers got to be IT really all the way. And along with that, of course, there's a Radico also, for instance, a bit of a choppy day, and now it's finally spiked up about almost 5% as we speak right now. Eternal, of course, has been a strong one. Kalyan Jewellers too, it's closing in at the high point of the day. It's a solid 8.25% move that one is seeing. Sunil, just wanted your own anticipation on, how these jewelry retailers need to be moving now. I mean, as we speak, there are names like Titan which have made a fresh record for themselves. But, it seems like a sectoral move now.
It seems like that because I think gold prices have been choppy and buying interest starts when gold corrects a bit. So I think that's what is probably driving the sentiment around this pack. Because the whole war situation and the dollar strengthening has meant that gold and including silver have been a little bit under pressure over the last few months. So that, I think, is actually a favorable tailwind for the jewelers, because if you saw earlier when gold prices were rising, there were a lot of people with just trading in their old jewelry for the new ones. Fresh buying was really limited. But now I think that should change. We are running up into a festival season and a marriage season on the cards. So demand should pick up from that point of view. So I think that sentimental tailwind is what is driving up the whole jewelry pack.
Okay, let's also analyze what is that we can expect from Asian Paints, and a steady quarter it seems is what is anticipated, with revenue, EBITDA and profits all seen growing in the low teens on a year-on-year basis. In fact, Rabinder is here from our research desk to tell us more about what to expect from Asian Paints.
Well, as Asian Paint is set to announce its Q1 FY27 earning, and CT is estimating a good set of numbers for the Asian Paint in the quarter gone by, with revenue likely to saw an uptick of approximately 14% on a yearly basis, which was supported with an estimated volume growth of 9 to 10% and driven by the improving demand traction in decorative paints segment and pricing-led growth. And however, EBITDA margin are expected to remain largely flat at 18.1% as higher raw material costs are likely to offset the benefits of the operating leverage, and the quarter is expected to benefit from the price hike implemented between March and June 2026, along with a healthy industry demand, and demand further supported by pre-price hike stocking in April, while momentum remain healthy through the rest of the quarter. And the international business is also expected to report a steady set of number for Q1, and it will be, if we talk about the key monitorable, then management commentary on the possibility for the price hike amid raw material price volatility, demand outlook, gross margin trend, dealer network expansion and market share gains. It will be key watchable.
Okay, that's the anticipation coming in from Asian Paints. Having said that, Sunil, does it seem that a major chunk of the damage for the oil sensitives, your aviation, paint companies, etc., could be well in the price by now?
Well, you'll have to ask Mr. Trump that question. His tweets drive everything. You saw the price went from 72, 78, all the way up to almost 100, back down below 90, all without really much changing. It was just a series of America's intentions around the war, stated intentions and then actions. So I think, it's very hard to say what's the future, honestly speaking. So I would still say that this recent oil, change, because he said now talks are progressing. What's the bet that tomorrow he comes and says the talks have failed? I'm stepping up my action. So I would say, stay cautious around this whole pack right now. Let's wait for a little more certainty around the Gulf War, status. Predicting Mr. Trump has always hurt you.
Absolutely. Couldn't agree more. So, Shivangi, not Asian Paints or Interglobe Aviation or OMCs, let's have you read the charts for Brent. Does it seem like this cool off that one has seen play out for the last 2 days? Is it going to sustain around $86 per barrel thereabouts?
Absolutely, Aisha. Now, I know you would be delighted to interview Mr. Trump and have those questions answered. But, looking at the entire movement right now for the crude, we're seeing some of the, cool off, of course, has happened over here, and some of the crude-related counters have actually done pretty well. So Indigo is our preferred payment chaser, and we've seen a Poland flag pattern formation breakout on the weekly basis. So definitely momentum is there for the near to short-term basis, and Indigo could be looked out for benefiting from the drip in the crude oil. Now, Indigo, we're looking at 5,500 as the next targets on an immediate basis and a support of 5,150 level.
5,150 on Interglobe Aviation. That is what's Shivangi's reading on the cards. But Shivangi, we'll let you go on that note. Thanks as always for taking the time out and joining in. Eicher as well is due to report its numbers tomorrow. Let me quickly take it across to Avi and understand what exactly to expect.
So Eicher Motors is going to come out with its Q1 FY27 numbers, and let's have a look at what we are estimating here at ET Now. We are estimating the revenues to come in at 6358 crore rupees, which will be a 26% growth on a yearly basis, and the EBITDA coming in at 1520 crore rupees. What will be important to look out for will be the EBITDA margin, since the commodity cost inflation is impacting two-wheeler OEMs across the industry. We are estimating them to be at 23.9%, which will be flattish on a yearly basis, but a 1% decline sequentially, and the profit to be at around 1400 crore rupees. The Royal Enfield volumes are expected to be in the range of 330,000 units sold for the quarter gone by. The Royal Enfield domestic growth has been really strong on a yearly basis, but the export markets have been weak. The VECV margins can be seen under some impact due to commodity cost inflation, but the capacity expansion that the company is taking will help company scale up their volume. So some of the things that to look out for will be the demand outlook, including their export market outlook, the margin trajectory that the company posts, and whether they are able to uphold their margins at 23.9% up or down, the further pricing actions that the company takes to maintain the realizations, and the series of product launches that they announce in the upcoming years to come.
Right, okay, that's the expectation then from Eicher Motors as well. 2 minutes actually left to go before we wind up for the day. Sunil, thanks as always for joining in. Good to be speaking with you on the show. Let's begin winding up, and it's been very sideways and range-bound a session really for the Nifty 50. We're closing in just about marginally soft. Unfortunately, we couldn't quite hold on to that 24,000 mark, which we did scale up in trade yesterday, even though the cool-off in crude continued. 23,986 is where we're shutting